Hello and welcome to the Download. I'm your host, Dave Richardson, and today, special edition of the Download podcast because we have a new guest, an old friend, but a new guest, and that is Steve Pitts, who is the Vice President and Portfolio Strategist for Fixed Income at RBC Global Asset Management. Steve, we've worked together for a long time, and really we needed somebody to break down what's going on in fixed income right now. It's what I think people spend too much time focused on the stock market, not enough time focused on fixed income. If we look at Canadians overall, Canadians hold more fixed income than equity. The average Canadian investor would be a conservative investor, about 55% bonds, 45% stocks. And when you have some of the things that are going on around the world right now, fixed income tends to be the canary in the coal mine for things that are that may happen in equity markets. So we wanted to get you on to do a whole sort of, we're going to go all around the world for 2025 and 2026. And Steve, the listeners are nervous because they're used to a particular set of guests, but I know you got it in you. Are you ready to go?
Ready to go, Dave. Look forward to it. Yeah, fixed income, exciting world of fixed income.
Yeah. Well, the people who are watching on YouTube will
Yeah,
already find out that you're better looking than most of the guests that we have. So that's a good thing. And you've got that radio
that's
voice for those listening on the podcast. And don't forget to subscribe to us wherever you get your podcasts and wherever if you're on YouTube. And we love a glowing 5-star review for Steve's fabulous appearance today, and for his fabulous appearance in terms of information. So Steve, why don't we look back at 2025? We were talking a little bit before we started taping, and you had some thoughts on what we can take away from the experience in fixed income in last year.
yeah. So looking back at 2025, it was kind of a mixed year for bonds, I would say. One of the themes we did see is actually we saw kind of a fairly like the volatility of bond yields outside of what we saw in April was fairly low. And in fact, as you got into kind of the last few months of the year, the 10-year bond yield kind of ranged between 4 and 420. So it was a pretty tight range. So
Yeah.
if you look at other volatility measures like the MOVE index, which is kind of the treasury version of the VIX index,
Okay.
it had been elevated around 2022 and kind of has moved down back to, call it, kind of pre-COVID levels. And so if you look at the performance of bonds, it was kind of again more mixed. If you're in the shorter end of the curve, that part of the curve benefited from the Bank of Canada cutting interest rates, and so we saw kind of 3.8, 4% type gains on the short end. The long end was a little different, as you saw a bit, yields increase on the long end. So you kind of got this twist of the yield curve where yields came down in the short end and they went up a bit on the long end. And again, the short end's really driven by what the Bank of Canada is doing in terms of cutting rates. But the long end is often driven by other factors. And this year it was when we saw this really around the world
Yeah.
in terms of with the increase in fiscal spending, maybe a bit around stickier inflation. We saw and the resultant need for more debt issuance to support that. There was concerns about that, and we saw yields in the long end kind of tick up as a result of that. And so, if you look around the world, really, it was U.S. actually ended up being U.S. Treasuries was the best performer for the year, which is a
Really?
bit surprising
Yeah. Yeah.
given what we went through in April and the narrative around foreign investors selling U.S. Treasuries. That ended up not coming to pass in the longer term, and so U.S. Treasuries were actually the best performers. Canada was kind of in the middle, and Japan was actually amongst one of the weaker ones. Again, with yields going up, particularly in the long end of the curve there. So again, it was where you kind of got a little bit, coupon, maybe a little bit less than coupon on something longer term because of that weakness in the longer end of the curve overall around the world.
Yeah, which made it kind of a, if I look at different diversified bond portfolios, and we talked to Sarah Riepel a couple of episodes ago with respect to fixed income within the context of an overall portfolio of stocks and bonds. it was a pretty boring portfolio for bonds. I mean, almost a
Hmm.
throwback to the 1990s when Steve and I were in our heyday in Toronto, and our
Yeah,
careers were promising until they ended up here. But where you had sort of short-term government bonds became sort of the place to be, and then
hmm,
you can't get a whole lot more boring than U.S. Treasuries for that. So the portfolio
yeah,
looked very it wasn't a great and exciting year to be a bond manager, right? Because all the
yeah.
different things you can do across credit and in different parts of the world, you weren't really doing as much last year.
Yeah, it's true. And there was, I mean, in some ways, boring is good for bonds, right? Like you want bonds to be the
Yeah.
boring part of your portfolio, as much as I hate to say, especially after the last few years. I'll take a year of boring, right? So,
Yep.
but yeah, to your point, there wasn't without a lot of volatility. There's not as much that active managers can do to take advantage of that. The one thing you also got too, which really helped, was on the credit side. You did see spreads kind of narrow in after widening out in the period of around Liberation Day tariffs.
Yeah.
They did end up for the
Yeah.
year pretty much narrow, whether you're looking at investment grade, high yield, or EM. And that came against a backdrop of really record issuance in the Canadian corporate market. We saw record corporate issuance and pretty high corporate issuance in the U.S. as well, with both investment grade and high yield.
Yeah, and you probably get the same comment from your friends and family. I know my wife would certainly say, "Boring but good." Good is a very good
Yeah.
description of me. So that's
Exactly. Yeah.
I'm cool as a banker, but not in the rest of the world. I'd be considered boring and good. The
Yeah.
so that's kind of 2025.
Mhm.
As we move into 2026, we've already had a little bit of excitement
Mhm.
in fixed income markets. So where do you want to start in terms of what we've seen already and where or maybe do you want to set the context? Why don't before we go into 2026, let's set the context around interest rates overall and kind of expectations for this year of where things move.
Sure. Well, I think, if you look at our forecast for a lot of for our different bonds in both Canada, US, and even around the world, I would say we're generally expecting, we don't have a very strong directional view, I would say, in terms of yields. And so, for the most part, we're expecting yields to end up pretty close to where they are today. So again, it looks like another year where it could be kind of this coupon type returns, although again, things happen along the way. And so, again, I think that's, I would say it's not a bad thing for bonds. Oftentimes people really want that big return from bonds, but you pay for that, right? Like the best you can get on a bond portfolio is getting your coupon and your principal back at maturity. And so if you get kind of the big capital gain, you end up kind of borrowing from the future, if you will, in
Yeah.
terms of returns. So, but so I would say no strong directional view. The Bank of Canada is likely at the end of its cutting cycle here. The market's not really pricing in any more cuts. Probably get a couple more from the Fed. I think depending on what happens with the economy and the renegotiation of Kuzma, and, that you could actually see, we'd probably be biased to more likely see perhaps one or two more cuts from the Bank of Canada potentially if
Wow.
things do weaken. And I think that's an important point too for bonds. While we don't expect much in terms of yield changes, I think the caveat would be that if you did see some weakness in the economy, weakness in the labor market, that's where you could see more aggressive cuts from Bank of Canada, from the Fed, and yields coming down. And that's, I think, where you'd get that kind of more of those gains and that ballast within your portfolio.
Yeah, and we always talk about bonds and the traditional role that bonds play, of course, generating income,
Mm-hmm.
somewhat stable income over time, but also as an offset to what's going on in your stock portfolio. So I know when I'm talking to investors and advisors across Canada, they're concerned, and they often express concern when markets are at all-time highs. Obviously, we have a different type of president in the U.S. with a different approach, particularly to communication or maybe dealing with friends, and so that unnerves markets. And so having that, the protection of the insurance, I guess the classic insurance of bonds, is important. And then depending on how much risk you're taking in your portfolio, it doesn't seem like, as you say, the boring is good is a great line to say. You can have those bonds as the offset to the volatility you'll see in equities. And
Mm-hmm.
then if you're a more conservative investor, it's going to create a lot more comfort for you coming into the kind of year we're going to have.
Yeah, and yeah, to your point, I think there's, how you structure your bond portfolio can perhaps be based on, I would say there's three main objectives for bonds. It can be stability, equity diversification, and income. And it's almost like a triangle, and what kind of bond you own, tilts you toward one of those three objectives. So if you really want to focus more on that equity diversification, you want higher quality bonds, maybe a bit longer term bonds. If you want more focus on income, you'd have more credit, more stability, you might be more kind of shorter end bonds. So, and as you move toward each of those points, you kind of move away from the other ones, right? So there's always this trade-off between those three. And so, the one thing I would say though, I talked about the yield curve kind of steeper now, and it is a bit of a different environment than what we've been used to in the last couple of years, because it's been a very flat yield curve environment for a couple of years, and so you haven't been paid to go further out the curve. And
Yeah,
so it's been easy to stay in cash, because cash is giving you the same yield that a 10-year bond was getting. But
yeah,
today, you now have, you are getting paid to go further out the curve in bonds, which I think is an important differentiator, because 2 years ago, if you wanted to get better yield, the only option was credit. But now you can go, you look at, for example, our flagship RBC bond fund has a yield of 3.8 versus our money market fund of 2.2. So you can get, almost double the yield now from a bond fund versus from a money market fund. So I think that's a bit different than what we've seen in the last couple of years. So I think kind of an important feature to highlight of the bond market today too, I think.
yeah. So that's interesting. And one of the other things off steeper yield curve, and you've already kind of seen it over the last several months, is financial stocks start to look fairly attractive. And you've got that steepening yield curve in most, I guess, developed
Mm-hmm.
markets around the world, even some of the emerging markets, and that creates some opportunity, as we've talked about with several of the other portfolio managers who are managing money in the equity space in all around the world. But so then, Steve, if we move out to kind of high grade corporate,
Mm-hmm.
Canada, U.S., and in other parts of the world, is that looking like an attractive space? Because you said that with the steepening yield curve, we actually do get rewarded a little bit for going a little bit longer. But are we gonna start to see where we get rewarded somewhere in the world in that high grade corporate space?
Yeah. So credit in general, I would say, the fundamentals are really good in credit. We have a pretty solid economic backdrop here, not a lot of, in terms of like the profits are strong. There's not a lot of distress, if you will, in the system. So, I would say for investment grade and even, higher yielding debt, fundamentals are good, and the technicals are pretty good. There's very strong flows, strong demand for credit today, and that's why you're seeing this increase in issuance. I would say there has been some. I know our colleagues in the US have talked about this element of the rising corporate issuance in the US, expected from some of the hyperscalers, for example, are
Sure.
going to be coming to the market. And so we could see US corporate issuance hit $1 trillion this year, versus I think it was 600 billion last year, something like
Yeah.
that. And so there is going to be a lot of issuance. So far, it's been met with pretty strong demand, I would say. The one concern is that you have pretty tight spreads in terms of that risk compensation you're getting for credit pretty much across the board, whether that be investment grade, high yield, or EM, is lower relative to average. So that doesn't mean you need to abandon it. It just means that you don't have as much of a buffer built in there if something does go wrong, if something unexpected happens within the economy. You could see spreads, widen out a little bit and credit underperform. But overall, I would say within a lot of our portfolios, we do still maintain kind of an overweight to credit position, more so in a lot of our funds in kind of the shorter end, that 1 to 5 year end, where you have a little less kind of vulnerability, more higher probability of outperforming there. Um, but it is, I guess, I think you often see for credit that you can stay at fairly tight levels for long periods of time, and so uh, when you get to these points, it's important, I think, to still have that allocation. But I think this is a point in the cycle too where active management can be valuable, and this is where your
Yeah.
credit team comes in to really pick and choose where you go within the credit market. And so I think it's a part of the cycle where that becomes perhaps a bit more important, to be a bit more selective out there.
Yeah, and I really think because it is, as you say, such a dull market and spreads are so narrow, but the geopolitical backdrop, as we could say, you could probably even say it's almost crazy or nothing like we've ever seen before. So you
Mm-hmm.
never know when something's going to happen where those spreads so pop out. And we should say, we should do some defining here. If you think of government credit as being the lowest risk, you think the Canadian government never missed a bond payment, right? When we buy a bond, we're
Mm-hmm.
lending money to whoever we're buying the bond from. So if we lend money to the Canadian government, they're very reliable, extremely reliable. So, the interest, the yield is going to be at a particular level. If we're lending money to Argentina, which defaults every 10 years or so, then we might demand a higher rate. So think of it as if I was lending Steve $20, very reliable guy, as you can see on the podcast here. I would expect to see that $20. So I would just say, give me $20 tomorrow. Steve repays it. Some of our friends, Steve, we know who are much less reliable, give the $20 and you may see it. So you say, well, I'm going to give you $20, but when you give it back to me a year from now, you're going to give me 30, right? Because they're a higher risk. So we're gonna expect a little bit more back on the other end. And that's kind of the difference in terms of credit levels from
Mm-hmm.
government to corporate grade to high yield. Very an oversimplification, but what happens when you've got that political instability is, well, at some point we get some noise in the background. Say somebody's going to invade Greenland, and that creates some concerns that that's going to hurt the global economy because of all the uncertainty. And all of a sudden, some of those riskier bonds, the yield goes higher, and what that does, if you're an active manager, and this is why active management is so important in fixed income, is that active manager versus an index can go and shift the weighting from the lower risk to the higher risk so that when ultimately the noise is down, the angst goes down, that nervousness level, the yield drops down. And of course, when yields drop, the price of the bond goes up, and that's where you make money in the bond market. And so that backdrop that we have geopolitically creates these short-term spikes of volatility and move in the spread, which really creates some exciting opportunities if you can get access to them, and that's where a big active manager adds value.
Yeah, for sure. And to your point, when you're an active manager, and especially our teams have kind of a, 2, 3 year kind of time horizon, they're thinking, well, spreads are tight today. There's probably going to be over the next 18 to 24 months a time where I can get in at perhaps a better valuation. So I might have kind of if you think of a range of allocation to investment grade, I might be at the lower range today. And then as spreads widen out, there is an opportunity to transition into that. So that tends to be how we thinking of it. And again, I will say to your point with investment grade bonds, high quality corporate bonds, it's very rare you get like an actual default in that part of the
Yeah,
market.
yeah,
And it's because you're talking, Canadian banks, pipelines, the telecom companies, very high quality companies
yeah.
the risk tends to be more just the kind of volatility around that risk premium that you're getting.
Yeah. Now going back to my analogy of reliable friends.
Hmm.
So Steve, I said, extremely reliable. give him 20 bucks so he can go and buy lunch, and I know I'm getting it back next day or the day next time I see him. But if I were to lend Steve $1 trillion,
Hmm.
again, as reliable as he is, I might start to at some point get worried that $1 trillion is a lot for Steve to repay me. And that ties to the US economy, which is carrying $38 trillion of debt, and the Japanese economy, Japan, which is carrying, I think it's north of 250% of GDP, debt to GDP ratio. And we've seen some activity at the longer end of the bond of the yield curve in the U.S. and Japan that has been particularly interesting early in the year. So, with that setup, why don't you tell me how you're going to repay the $1 trillion, Steve,
Sure.
or tell me how
Yeah.
Japan and the U.S. are going to manage repaying all these trillions of dollars?
Well, certainly, in the last few days, we'll start with the US, we've seen some volatility around that longer end. And what you're seeing is kind of it's really that concern about if you're kind of a longer term treasury investor, concern about the viability, not the viability, but the willingness of the US government to repay you. And if that, you get some unease about that, that does lead to some volatility, some kind of capital flows out of the US if they kind of lose trust in the government. That's an important, if you're a bond investor investing for 30 years in a government, you have to have some level of trust. And if that starts to erode, that's where you can see those yields move, particularly at the longer end. And so we have seen that a little bit recently. It's with the kind of reversal on Greenland. We've started to see, yesterday and today, the long end started to come down in the U.S. and we're kind of back. Just if you look at the 10-year, just back above kind of that 420 level. Japan has been kind of an interesting story. Historically, we've seen Japan yields very low, inflation. It's been battling deflation for the last number of decades. But you've now, really every other developed market country, has been raising rates to fight inflation. Japan has been much slower to do that. And so you've started to see, for example, a 30-year Japanese government bond, JGB, has moved from, I think it was around 1.5% a couple of years ago to it's 3.7%, I think
Wow.
today, somewhere in there. So we've seen this big rise in the long end for Japanese government bonds, and a couple things driving that. This, I think there is. You've started to see the Bank of Japan hiking interest rates, expectations that will likely continue. And they also have a new prime minister that has been very pro-growth. And so there's been concern about more fiscal spending, to your point, adding on
Yeah.
to that already fairly large debt load in Japan. And so as a result of that, we have seen yields on the longer term end rise quite markedly in Japan. I think even the last year it's been over 100 basis points, which is big for a 30-year bond that doesn't
Yeah.
tend to move quite as much. I would say though, at these levels, a lot of our investment teams are thinking that it's actually fairly attractive, and we've been adding a little bit in some of the mandates to kind of that longer end of the market in Japan, and especially if you consider uh, like the benefit you get from hedging. So if you're buying the JGB, you actually also get a positive carry on the currency hedge.
Okay.
So on a currency hedge basis, you're getting over 5% now on a 30-year Japan government bond.
Wow.
So it's pretty attractive yield compared to, in Canada, 3.6. And even on US high yield, you're getting on a hedge basis back to Canada, something close to 5. So we do think that, yields are attractive there. We don't, I think for things to get worse, you would have to think that Japan is an emerging, turns into an emerging market country and has a currency crisis.
Yeah.
But, we don't really see that happening. There might be some continued volatility, but if you look at what the market is pricing in, over the next number of years, it's pretty aggressive. Like I think the market is pricing in the Japan 10-year bond 10 years from now to be kind of 4.2% or something like that, which is
Yeah,
very high, right?
yeah,
And
yeah.
so we don't think policy rates are going to be anywhere near that. Japan still is a very low growth country. And so anyways, there has been some volatility there. If anything, we would view it more, we think the risk premium you're getting is actually pretty decent in the long end of the Japanese market today. And so not something we necessarily expect to continue for a long period of time.
Yeah, and just to kind of put the Japan U.S. thing in perspective, say I'm a relatively successful person in Canada, good steady job, high income. I get into the housing market. I buy a house that is suitable for me and my family. So I'm probably paying $2 or $3 million for that. So I might be carrying a fairly large mortgage. If I've just had a 5-year mortgage mature in Canada, the rate was around 1.5% that on my 5-year before, and now I'm going to renew into a rate in around 4%.
Mhm.
And again, my payment goes from, I don't know, 1,000 to $2,500. Now, I much preferred the 1,000. That was a lot better. I can still afford the 2,500, but it does change my lifestyle. It has an impact across other financial decisions I'm making. And that's kind of what Japan is facing, right?
Mhm.
When those rates go up, you've got all this debt. Now you have to pay more to service that debt, just like you're paying the mortgage. And then and so it sort of constrains your options in terms of what you want to do as a government to drive economic growth or support the economy. And so that's what Japan, very high debt. The U.S. very high, not quite as much, but very high. These countries have huge tax bases. They generate huge amounts of revenue. So they no reason to believe they're not going to be able to service that debt. But it does start to constrain their options in terms of government policy.
Yeah, yeah, it's certainly that cost factor to your point. As bonds mature and they're reissuing new bonds at those higher coupons. The U.S. is facing that. A lot of countries are facing that, but certainly in Japan, where you've seen a pretty big move, that's something that's come into play. The other factor too is I think the Japan Ministry of Finance has been kind of slow to adjust where they're issuing as well. They've issued a lot in the longer term end, and historically local players and to some extent the central banks have been buying some of those bonds as well, but they're doing less of that. And so, in our view, they've been a little bit slow to adjust. They've started to now adjust the issuance, moving it a bit. So I think that might
Yeah.
help the situation as well.
And that's a big thing that again with all the
Mm-hmm.
noise around the U.S. economy that you don't hear enough about if we're talking specifically about bonds. The U.S. has made that pivot to
Mm-hmm.
issuing that shorter term debt, and that again helps the cost and gives them a little bit more flexibility in the near term around the economy to hopefully increase growth, rates continue to come down, and start to at least do something about their debt and deficit over the next few years. So we have
Yeah.
seen that in the U.S.
Yeah, and the
Maybe just
U.S.
finish.
administration. Oh, so I was just going to
No,
say,
no, go
I
ahead,
know
Steve.
the
Yeah,
U.S. administration certainly is keen to, while they talk about, cutting interest rates, they're really keen to cut mortgage rates. And if you want to do that, you need the long end to come down because
yeah,
a lot of mortgages in the U.S. are at that 30-year term. And so the risk is if you get if Trump pushes for cuts in the short end of the curve, that actually could work against the
the
long
opposite.
end, and you
Yeah,
actually could see the long end go up as a result of that. So they do, whoever gets kind of put into that spot as Fed chair, it has to be mindful of the implications of, really, if you want that long end, you want to maintain that credibility, maintain that inflation fighting narrative within the at the short end as well.
Let's just finish off, Steve, with just
Mhm.
a quick summary on the Canadian bond market in terms of rates and credit. You talked about potential cuts from the Bank of Canada. And then similar in Canada to other parts of the world, maybe we see some creep at the longer end. But what's the expectation, and where do you see the sweet spot being in the Canadian bond market in 2026?
So I think, it is probably a market where you're getting similar kind of 3.5, 4% type returns on bonds. And, and then again, I think we found from a credit perspective, we do kind of like the shorter end of the credit curve in particular. So I do think, the one thing I would say is, it is a pretty attractive time in relative to the last number of years to be owning bonds, given where yields are. You might remember 10 years ago, yields were closer to 2%, right? And so, we've kind of gone through this period where yields have normalized. And yields are your best predictor of future return, right? And so, yields today are, like I said, on our bond fund, kind of anywhere between just under 4%. And so, that's so you're in a spot where you're getting good income on bonds today, and I think that's it's one of the reasons you're owning it. And I think importantly, I think the bonds will act as a good ballast against the equity part of your portfolio if you do see some volatility. And so we do like the opportunity in bonds today. Might be boring, but I think it's that important part of your portfolio, though, that I think helps you, sleep at night, really, within the context of your overall portfolio.
Well, that's why I wanted to have you to do that summary, Steve, and fantastic job. We covered a lot of ground in 30 minutes. Thanks for agreeing to do this. I hope you'll come back. Will you? Did we
Sure,
was it
absolutely, yeah,
a good enough experience? You'll come
yeah.
again?
It was
Yeah.
okay. It was great.
E-
Yeah, no, I appreciate
Even if
it.
even if I come down to your desk and demand my $20 immediately, is
Yeah,
that
that's right.
okay? All right,
I don't know. Last time I borrowed 20, you were asking for 30 back. So
well, that's we are
yeah,
focused on returns, which is why we do this podcast. Steve, thanks
yeah.
for joining us, and we'll see you soon.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.